Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 5, NPV and IRR. If you're using the Benninga textbook, look at chapters 2 through 4 to give you a good overview of discounting, discount rates, NPV and IRR. Now, NPV and IRR are measures used to evaluate investment decisions. They're used to ensure that investments' returns will exceed the cost of capital and create value for the firm or individual. In this topic, we're going to apply NPV and IRR techniques to evaluate personal investment decisions. We'll start off with NPV, or net present value. NPV is simply the present value of all cash flows, including the initial cash flow. So the basic criterion to use when you decide whether to accept a project or not is to simply accept all projects that have an NPV greater than 0. The NPV formula, we just take the first cash flow received today, that could be positive or negative, and then all future cash flows discounted at some discount rate R. And if that is greater than 0, we're going to accept the project. If it is 0, that means that it's kind of a break-even project. The cash flows will be sufficient to pay off the cost of capital of capital providers. Internal rate of return, or IRR, is another measure used to look at investment projects, and it is literally just the NPV break-even discount rate. So let's look at the formula. This looks like the NPV formula right here. However, we just set the NPV formula equal to 0, and we just simply find the single discount rate that makes the NPV 0. So NPV and IRR are very related. IRR is simply the break-even discount rate. The criteria for whether you accept a project with IRR is simply accept all projects whose IRR are greater than something we call a hurdle rate. Now, that hurdle rate is often the cost of capital. So let's go ahead and calculate NPV and IRR. So we're going to go to the start file. And we have a little example here. We have a NPV discount rate of 10%. This project is going to cost $100 today and return $115 in 1 year. So let's calculate the NPV. I'll just take the present value of all cash flows. The present value of the first cash flow received today, well, that can just be $100. The present value of the cash flow received next period is the 115 over 1 plus that discount rate, raised to the 1 power. And if there are more cash flows, you can do more. If we just sum those up, we call that the NPV, the net present value. Now, IRR is the discount rate that ensures the NPV is equal to 0. So we can try to change the discount rate to say 11%. Oh, looks like I have one little mistake there. Let's change that. It looks like I don't have that cell right there. All right, so that's better. The NPV is the first cash flow plus 115 discounted at 10%, not 0. So the NPV is 0. So the NPV is $4.55. So let's look at the IRR. Now the IRR is whatever discount rate here would make this 0. So we can try 11%. We can try 12%. You try 13%, and so on. Or you can just run a goal seek. Data, what if, goal seek. Set the NPV to a value of 0 by changing the discount rate. And then you see that the NPV, or the IRR, in this case is exactly 15%. But I'll change that back to 10. Now you can also use the IRR function. IRR, put in the initial cash flows, not the discounted cash flows. I make that mistake all the time, but the initial cash flows, and you get your IRR. Now let's talk about the meaning of the IRR. The IRR is literally the return on the initial negative cash flow. So in this case, we spend $100 today, and we get $115 next year. So $100 minus or 115 minus 100 over 100, that's a 15% return. That is what IRR is telling you. It's the return on the initial negative cash flow. Therefore, IRR requires that the first cash flow be negative. Now let's talk about what the NPV means. So in this case, let's pretend that the NPV discounter is 10%, and where we got that is that's our cost of capital. All right, so let's say this project was financed by a mix of debt and equity, and on average, those capital providers want a 10% after-tax return. So if the NPV is $455, what that means is you had enough money to pay off your capital providers. So this is a very simple example. You're going to borrow $100, in this case, from the capital providers. I should say get funded. When I say borrow, that implies debt. You're going to get funding for $100, and if the capital providers want a 10% return, that means that you're going to have to give them $110 back next period. So if you borrow $100 today, you're going to have to pay back $110 next period. Now next period looks like we're actually earning $115. So that difference, that $5, is the extra cash flow next year over our cost of capital. In other words, it's the $115 we receive next year minus what we'd have to pay off our capital providers. And that is $5 received next year. However, the net present value needs to bring that $5 back to today. So what it literally is next year's excess, cash flows over our cost of capital, discounted back to the present at the discount rate. So in other words, $455 is the present value of the extra $5 we had. So there's our solution. So let's do a little bit of harder problem. Now it's a project that has 5 periods, 6 if you include today. And notice the cash flows are kind of interesting. They're actually in just reverse orders. Both investments cost $500, have a discount rate of 8%, but 50, 100, 150, 100, and 250. And this one is the same cash flows, but they're in the opposite order. The first one is 250 versus the last. Let's calculate the NPV and IRR of these cash flows. So let's calculate our NPV. Present value of the first cash flow is 500. And then we can take 50 over 1 plus my discount rate. I'm going to anchor that and raise it to the year's power. I'm going to copy that formula down. And there we go. I got the sum of the 5 future cash flows is 494. And if I take the 494 and add in the negative 500 today, that is my NPV. In other words, this formula here is the sum of the 5 future cash flows and the current cash flow. Now we can do let's actually use the MPV function. So there is a function called NPV. And I'm going to bring up the wizard, or the dialog box for that. It asks us for the discount rate, 8%, and it asks for the values. Now notice there's an odd thing going on here with the NPV. The NPV function in Excel, the first value, it says value 1, is the cash flow received at the end of the first period. So in other words, we actually can't put the initial cash flow in there. So what we need to do is put in the future cash flows, not discounted cash flows. And that is the Excel function for NPV. But notice it actually is not the NPV. It's misnamed in Excel. It's actually the future, it's the present value of all future cash flows. So we have to take the NPV function and we have to always add back the first cash flow. In this case, it's negative. So there we go, is your NPV. And then we can calculate our IRR. Notice our NPV is 0, which means our IRR must be less than 8%. And there it is, 7.67%. So in this case, both the NPV and IRR give us a consistent message here. The NPV is 0, so we do not accept the project. And the IRR is less than, in this case, if we assume this is our cost of capital, the IRR is less than our cost of capital. In other words, this project returns 7.67% per year, but our cost of capital is 8% per year. Therefore, we wouldn't even have enough money to pay off our capital providers. We can do it for the next project B. Take the first cash flow. Let's use the same discount rate. Discount it back to the year's power. Copy it down. Get the present value of all future cash flows. If I add in the initial cash flow today, that is my NPV. And then I can use the NPV function to only look at the future cash flows, not the discounted ones. Well, I got to put the discount rate in first. Discount rate, comma, future cash flows, and add back that first cash flow, which in this case is a negative number. There's my negative, or my NPV. So this implies the NPV is greater than 0, therefore I want to accept the project, which must mean that the IRR must be greater than 8%. And there it is, 12%. So that's NPV and IRR. They're used to make investment decisions. So let's talk about one other way to calculating NPV, and this is Excel's XNPV and actually Excel's XIRR function. In this problem, we're going to assume we have a project that costs us $13,500 today and return $1,000 every 90 days for 20 payments. That's 5 years. So we're going to calculate the IRR and NPV assuming annual year-end payments, and then compute the XNPV and XIRR assuming actual payment dates. Now the XNPV and XIRR functions, pretty cool functions. They allow you to put in dates, not periods like 1, 2, 3. So let's take a look at that spreadsheet. So in this case, we could put in our cash flows. Our first cash flow is we're going to spend $1,350 today. And then it's going to pay $4,000 a year or $1,000 every 90 days. I could simply, oh, looks like I missed the first cash flow there. I could just click on my 4,000 and copy that down. Those are my total cash flows. I can calculate my IRR. 14.71%. In this case, my discount rate is 16%, so the project does not look like it's going to be a good project. Must mean the NPV is going to be 0. So let's calculate the NPV. I'm going to put in my discount rate. Let me anchor that, comma. My future cash flows, those are the 4,000s. Now you need to add back that first cash flow. And there's my NPV, negative $402. So they're a consistent answer. Don't accept the project because the IRR is less than my cost of capital in this case. We'll assume my 16% is my cost of capital. And the NPV is negative. However, cash flow timing is very important. This project does not make you wait a year to get the first $4,000. You get $1,000 every period. So let's pretend the cash flows start today, 12/1/2016. So let's put in that first cost, and then we're going to receive $1,000. I'm going to just take that number, divide it by 4, and then I'm just going to copy those numbers. So this project is going to return the same cash flows as the annual cash flows to the left, but you're going to get them a little bit sooner. You don't have to wait 1 year than 2 years. You're going to get it in 3 months, 6 months, 9 months, 15 months, 18 months, and so on. If you use the exact timing of the cash flow, you'll get a more precise NPV. Now the intuition is the NPV has to be higher because the cash flows are closer in time than this here. Right, that you're getting all those cash flows. We're not waiting at the end of every year for every cash flow. We get them every quarter. So what we can do is we can calculate the XIRR, where we put in the values, comma, and then we put in the dates. And there we have the actual IRR of the project, assuming the actual timing. So make sure if you have exact dates, say months or quarters, use them. And we can calculate the NPV now, the XNPV. Right? It asks for the discount rate. We'll put that in, comma. Then we put in the values, comma, and the dates. And there we go, 4/24/28. A little note, the XNPV does allow you to put in the first cash flow. Unlike the NPV function where you had to add the first cash flow, the XNPV, because you enter the dates, it assumes that the first date is today's date. So that is XNPV and XIRR. Now let's look at making a personal financial decision using NPV and IRR. And this example is from the textbook. And this is Sally and Dave are considering a purchase of a $100,000 condo. And then they're going to rent it out. The condo, $100,000 is going to be capitalized. In other words, it's going to be depreciated. We're going to depreciate over 27 years. Now Sally expects to keep the condo for 10 years and then sell it for $90,000. We call that the resale value or salvage value. So the question is, what is the NPV and IRR of the condo, assuming that Sally and Dave's tax rate, personal tax rate, is 30%. The salvage value of the condo in 10 years is going to be $90,000. We're going to amortize or depreciate the cost of the condo over 27 years. We're going to get $24,000 rent per year. $1,500 is the property tax per year. We have $1,000 in miscellaneous expense. So what we're going to do is calculate the free cash flows of this project or of this investment. Now, a couple notes here. Again, as we talked about in earlier topics, that $100,000 that purchase today is going to be a capital expenditure in this example. In other words, a capital expenditure are those that have a useful life greater than 1 year. Therefore, you're going to depreciate their cost over time. And that's going to create, so even though the $100,000 is going to be spent today, there's going to be a tax effect by recognizing that depreciation over time. Now, businesses, a little technical note with accounting here. When businesses depreciate CapEx over the life of an asset, they depreciate the difference between the CapEx and the expected salvage, what they sell it for. So in this is our example here. We're going to spend $100,000 today, and we expect it to be worth $90,000 in 10 years when we sell it. If this were a corporate investment, we would only depreciate that $10,000 difference. However, in personal investments, you assume the final salvage value is zero. Therefore, we're going to depreciate the full $100,000 using our straight line depreciation. Now, salvage value. So we talk about the salvage value. It's the price of that capital asset, that CapEx, when it's sold. Now, the price we're going to get when Sally and Dave sell the condo is $90,000. However, we need to have after-tax cash flows. Now, the after-tax salvage cash flow is going to be what you get for it when you're done, $90,000, minus the tax on the difference between the salvage value and the net book value. So again, in this case, we're going to sell it for $90,000, and then we're going to have to pay taxes on the difference between $90,000 and whatever its net book value is. The net book value is going to be the original cost, $100,000, minus whatever the accumulated depreciation is. So we're going to calculate that. Now, when you calculate the after-tax salvage value, sometimes that tax benefit could be pretty big. So we want to make sure we always capture the tax benefit. So for Sally and Dave, we're going to calculate the free cash flows, which are going to be our EBIT times 1 minus the tax rate. We're going to add back the depreciation. We're going to subtract any change in non-cash working capital. However, in this example, it's 0. We're going to subtract that, the CapEx today, but we're going to add in the after-tax salvage, which is almost like the opposite of the CapEx. So let's go ahead and do the example or the spreadsheet. So let's go to the condo tab. Here are my inputs, my value drivers. And we're going to make a few calculations. First of all, it's a $100,000 condo. It's going to be depreciated over 27 years. So there's going to be annual depreciation of $3,704. Our EBIT, earnings for interest tax, is going to be our rent, minus our tax, minus our miscellaneous expense, minus our depreciation. Our tax is going to be our tax rate, Sally and Dave's personal tax rate, times the earnings before interest and tax. So that's going to give us taxes of $53.39 and earnings after tax of $12,457. All right, now let's try to get to cash flows so we can get the annual cash flows. We know the first cash flow is we're going to spend $100,000 today. But what's the cash flow a year from now? The after-tax free cash flow in 1 year is going to be we're going to assume, first of all these cash flows hold the same for all 10 years. So we're going to take our EBIT times 1 minus the tax rate, 12,457. That's the same value as here. We're then going to add back our depreciation and add those two numbers. So for the first, at the end of year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, we're going to get cash flows of $16,161. So I'm going to create a little link to that. That's my free cash flow for the condo. I'm going to copy that down and I'm going to anchor it. Now the last thing I have to account for is when I sell the condo at $90,000. This is the assumption. I sell the condo at $90,000. I'm going to receive $90,000 in year 10. However, I'm not going to receive the full $90,000 because what I'm going to have to do is pay taxes on the difference between $90,000, what I sell it for, and 10 years, or the net book value of the asset. Now, what's the net book value of the condo after 10 years? It's going to be $100,000 minus the accumulated depreciation. It's going to be $100,000 minus 10 of these payments. And here I have the calculation here. Here's the after-tax cash flow. It is B5, $90,000. I'm sorry. Yep, $90,000 minus the tax rate, 30%, times the difference between $90,000 and the net book value of the condo, which is $100,000 initial cost minus 10 years of depreciation, 10 times 3704. So the after-tax cash flow for the sale or salvage of the condo is $81,000. I'm going to add that to my final free cash flow, and this is what the investment's going to look like. Spend $100,000 today, receive $16,161 after tax for 10 years, and then sell it for $90,000 and have my last cash flow. So I can calculate now an NPV of this investment. Let's assume the discount rate is 12%. I'll put in all my future cash flows, and then I'm going to add in that negative $100,000, and my MPV is net $17,680. So over the life of this investment in present value terms, Sally and Dave will generate an NPV of $17,680. Or we can calculate the IRR of the investment, and we get 15.28%. We could do a little sensitivity analysis if we wanted to. You know, what if the salvage is between $50,000 and $160,000? And what if our rent is between $18,000 and $28,000 per year? Well, I can just put a link here to the IRR, because I want to do an IRR sensitivity. I can highlight this entire range and do a data, what if, data table. My rows are the rents. The original rent is here. My column are the salvage values. That's my original salvage value. So there we have some sensitivity analysis of what the IRR will be as I vary rents from 18 to 28 and salvage from 50 to 160. Now a note on loan payments and taxes. Now this is going to be needed for the assignment for this section. All right, the assignment. All right, the assignment in this section has you calculate the free cash flows to Sally and Dave if they finance the project using a loan. So what you're going to have to figure out in that project or in that assignment is you're going to get a loan schedule together and calculate the cash flows. We're actually going to calculate something called the free cash flows to equity. Now the free cash flows to equity are simply the free cash flows of the firm we've been using for the first 4 topics. However, you do include the debt cash flows. So these are cash flows only available for equity holders. So it's the free cash flows of the firm, but all the debt cash flows are included. So in other words, you take your EBIT times 1 minus the tax rate, you add back your depreciation, you add back you subtract your CapEx. By the way, we're going to add the after-tax residual. We take care of our working capital. There's none in the condo case, but here's the 2 differences. Since this is free cash flows to equity, we're going to subtract any principal payments on the loan. We're going to add any debt borrowing. So that's going to be a positive cash flow when you borrow the money. That's going to be a negative cash flow as far as the payments, the monthly payments or the quarterly payments. Also, we also need to take care of the interest expense. Now, the interest expense is going to be the after-tax interest expense. So you're going to create a mortgage payment schedule. You're going to figure out the interest expense for all the periods and calculate and multiply times 1 minus the tax rate and use the after-tax interest payments. Now I'll show you 2 functions in Excel or in the case that I posted. These 2 Excel functions are described, P payment and I payment. And if you didn't want to do an entire payment schedule for a loan, but you need to know each payment, what is the principal and interest of each payment, you can just use the P payment function and the I payment function. So let me show you how that works. I'm going to go to my loan. In this case, what if we created a loan with a $100,000 loan with an APR of 12%, annual percentage rate, and it pays or monthly payments. We can calculate the even payment. Well, first of all, let's get the number of payments. The number of payments is going to be 12 payments per year times 30 payments. It's going to be 360 payments. The monthly interest rate is going to be 12% divided by payment frequency. So it's 1% per month. Then we can calculate the level payment, the equal payment, using the payment function, where we'll put in the periodic rate, 1%, 360 payments. I'll put in a negative $100,000 as the present value. And there you have the monthly payment of $1,028. And now I could set up a payment schedule. There's my total payment for 360 months. And I can figure out the principal and interest in each payment. However, notice, look at this function right here called the P payment function and the I payment function. It has the same parameters as the payment function. However, it asks you which payment do you want the principal payment. So we just put in, we want a principal payment in the 5th period. So notice it says period 5, total number of periods is 360. So it tells me there's $29.77 of principal in the 5th payment and $998 using the I payment function of interest, and which is exactly the value using an actual table. So this will be helpful in completing that exercise. So let's do 2 more things. Let's calculate 2 more NPVs and IRRs. And the first one is a lottery example. The winner of the 2014 South Carolina lottery was given a choice of $223 million today, or a 30-year annuity starting today at $7 million, and that annuity grows at 4% per year. So the question is, what should the winner do? Should they take the 223 or should they take the 30-year annuity? Let's assume that the investor or the winner can borrow or invest at 3%. In other words, that's kind of their cost of capital. So let's calculate the NPV of the 2 different lottery payouts. So I either get 223 today. All right, I don't need to actually calculate the NPV of that. The NPV will be 223. Or I can get $7 million today, and that $7 million will grow at 4% per year. So the cash flows are going to grow, and that last cash flow in 29 years is going to be $22 million. And now we can calculate the NPV of this series of cash flows. But instead of discounting every cash flow, we just use our MPV function. Put in our rate, comma, all the future cash flows, and then we need to add back the initial cash flow. Anytime the first cash flow today, we have to take that outside the NPV function. So it gives us an NPV of 245. We can take the difference in those two NPVs, and it looks like we can create an extra $22 million in value by taking the second annuity. So the winner should definitely take the second annuity. Has the added bonus that they can't blow all the money in 1 year, right? You're going to have 29 years to get payments. Let's do another example. Let's calculate the NPV of a residential MBA investment. Let's pretend you're 24 years old today. Happy birthday. You're going to be 25 in 1 year. The MBA is going to cost you $20,000 per year after your fellowships. You're currently earning a salary of $65,000, which you expect to grow at 3% if you never get an MBA. However, you're going to forgo that for 2 years if you get an MBA. And after the program, you expect to get a job that earns $95,000 a year, growing at 4% per year. And then you plan to work to your age 65. Let's assume that the discount rate is 4%. What is the IRR and NPV of the MBA investment? So let's go ahead and do it. So let's set up our cash flows. If we get no MBA, we're going to make $65,000 next year. That's just an assumption. And we're going to get raises every year. We expect that to grow at 3%. No MBA salary growth. So that's what the cash flows look like. So if I don't get an MBA, I'm going to age 65, 41 years from now, I'll be making $212,000 a year. But what if I get an MBA? Well, my first year, I'm going to pay $20,000. My second year, I'm going to pay another $20,000. But the third year, I'm going to make $95,000. And that $95,000 is going to grow at 4% every year. Okay. Now I can take the NPV of each one of these, NPV. Now it looks like I'm going to put a discount rate of 4%. I'm going to anchor that, comma. Now I'm going to take the future cash flows. There is no initial cash flow today, so I can just use the future cash flows and I'm done. So looks like the NPV is the present value of my future earnings is $2.126 million. The NPV with an MBA is $3.256 million. So it looks like I'm creating $1.1 million of value over those 40 years in today's terms. However, if we want to talk about the NPV of the investment, it's not a $3.2 million NPV getting an MBA. We could just take the difference, 3.2 minus 2.1, and the NPV would be $1.1 million. Or we could just say the difference between getting an MBA and no MBA. So it looks like we're down $85,000 the first year, right? I would have made 65, but I'm paying 20, so I'm out 85, I'm out 86, and so on. So we can calculate the NPV of that incremental cash flow, and it tells me the NPV of choosing an MBA over no MBA. And I can calculate the IRR of my investment since the first one is a negative value. I can take the IRR. So what was the return of my $40,000 investment there? Or I'm sorry, my $85,000 and $86,000 first 2 years investments. It's a 20% return. So that's my NPV of getting an MBA. Now I just want to show you one little technique that a lot of companies use called modified IRR. Now the IRR formula assumes that if the firm has to borrow money, they borrowed at the discount rate. And if the firm earns money, it can reinvest the money added at that same discount rate. The modified IRR, or the MIRR, assumes that when there's negative cash flows, they're going to be financed at some finance rate, and the positive cash flows are reinvested at some reinvestment rate. So the MIRR computes the NPV making those two assumptions. Now how it does that, kind of tricky, is that anytime there's a negative cash flow, we're going to calculate the present value of all outflows. So the present value of these two cash flows, discounted at the finance rate, is 162. Then the future value in 41 years of all the positive cash flows invested at 7% is $11 million. And then we back into a rate of return by taking the future value in 41 years divided by the present value today raised to the 1 over n power minus 1, right? We did this formula in topic 1 or 2. So let's take a look at that spreadsheet. We calculate the present value of the negative cash flows, discounted at the finance rate, and the present value or future value of all the future cash flows. Notice I'm doing a future value. I'm pushing all the cash flows out to year 41. However, you don't need to do all that because all you need to do is use the MIRR function. The MIRR function says if you finance the negative cash flows at the finance rate and reinvest the positive cash flows at the reinvestment rate, your IRR is only 1084, it's not 1985. So that's MIRR. It just requires one more parameter. When you calculate MIRR, notice here it has the values, but it has a finance rate and an investment rate. So there's two discount rates. So let's do our last exercise. Or maybe that's all our exercises. Well, that's it. Well, that was fun. So let's talk about some principles over the first 5 topics. What are the principles so far in financial decision making? Number 1, cash is king. All decisions must be based on cash flows. Cash flows, not profits, go in your pocket. The second thing we're starting to look at is tax is really important. It affects cash flows, so you got to make sure that you include the effects of cash flows. Any additional revenues you're going to get, they're going to be offset with some tax bills. But any operational expenses you have, they also get a tax shield. Free cash flows, or the operating cash flows, also called the unlevered cash flows, the cash flows before debt, available to pay both debt and equity holders. Free cash flows of the firm is the easiest cash flow to measure to compute our NPVs, since it doesn't require a forecast of debt balances and interest payments. Although that condo case example in this topic is going to force you to account for them. Next principle, we care about cash, we care about after-tax free cash flows. The last thing is we can't just add up cash flows of different time periods. We have to convert all cash flows to present value terms so we can compare all the cash flows on an equal footing. In other words, what are they all worth today? And that's accounting for the time value of money. And the last principle we're going to talk about in the next few topics is the discount rate. In our NPV or in our discounting to calculate the present value of any factor, it should reflect the risk of the project. And in some circumstances, it could be the cost of capital. So in this topic, we calculated NPV and IRR, and we use them to make investment decisions. Our positive NPVs are projects we'd accept, and IRRs that exceed our hurdle rate, usually our cost of capital, also are projects we want to accept. In this topic, in the next topic, we're going to apply NPV and IRR to business decisions.